Hello all. Welcome to today's session on Proptech investing. Happy to have you join us for Venturus Group's annual flagship event, the Smart City Tech Week. Venturus Group is a city tech business builder and investor. My name is Frank Au. I'm managing partner of Pacific Pine Group, and I sit on the advisory board of Venturus Group, and I'll be your moderator today. In today's session, you'll meet the representatives of experienced Proptech entrepreneurs and investors who will discuss why investors are increasingly paying attention to this sector and how Proptech supports the global mission of decarbonization. Without further ado, I will let them introduce themselves, our panelists, starting with Brian Ye.
Hi, nice to meet everybody. My name is Brian Ye. I am based in the US, and I have for the last, since 2017, I've run the US corporate venture capital arm for Digital Garage, which is a big Japanese publicly listed internet company. And we have invested off of our balance sheet since the 2000s. And we invest across sectors and across stages. We generally tend to focus on enterprise, consumer, internet, AI, fintech, but we have also had a pretty meaningful amount of exposure to property tech. And I'm happy to be here with you today and look forward to the conversation.
Thank you, Brian. Next, I'd like Jia Teng to introduce yourself.
Hello, everyone. I'm Jay. I'm a co-founder here at Venturus Group, and I'm looking after our investment and portfolio management. So our focus, smart energy is one of our core focus right now here. Within smart energy, property sector is a big sector for us because it actually contributes a lot of carbons and energy consumption to the world. So very glad to be here today. Yeah.
Thank you, Jay. Next, I'd like Alex to introduce himself.
Hi, everyone. Good to be here today. My name is Alex. I'm co-founder and managing partner of a venture capital fund called Undivided Ventures. We're based in Hong Kong and also the UK. We focused on investing in technology, solving for sustainability challenges in the built environment. So that includes anything from real estate industry, construction to infrastructure. Our investment thesis is that the technology we invest in has to be accretive to developers' bottom line, but at the same time has to meet certain impact requirements. And every technology we look at has to be able to scale into Asia, where we see the biggest scaling opportunity. Looking forward to the discussion.
Thank you, Alex. Next up, I have Dominic Pinaloza.
Hey, everyone. Hi, yes, it's Dominic here. I'm based in Shanghai. I guess I'm the practitioner in this group. So I'm actually a so-called serial entrepreneur, Proptech practitioner. For those of you who know Naked Hub, which was my fourth startup, it was acquired by WeWork for $400 million. And that was the beginning of my Proptech journey. And I also founded what I think was the world's first Proptech incubator or Proptech startup studio. And we incubated Peace, which is what I'm focusing on now. So Peace is a Proptech startup venture. So happy to be here and looking forward to the conversation.
Dominic, we look forward to hearing more about Peace shortly during this session. And last but not least, I'd like Herbin Koh to introduce himself.
Hi, everyone. So I head up the growth equity business at Gaw. Gaw, we are a private equity real estate group predominantly focused on Asia. And I basically head up the growth equity piece of the business where we invest into verticals such as Proptech and climate tech. So the intersection between climate and also properties, real estate is what predominantly my whole team focuses on, and been doing this for the past 7 years.
Thank you, Herbin. Well, let's dive right in. So what I'll try to do is I'll mix up the order a little bit and I will call on our panelists. What I'd love to start off with is just what is the latest definition of Proptech? What is the most focus areas within Proptech that are catching people's attention? And maybe I could ask Alex to start us off, given his background.
Well, thanks, Frank. Thanks for throwing me in there. That's great. But Proptech, listen, I think Proptech, when I first started investing as an angel back in 2014, Proptech was something quite new. It was a catch-all for anything that digitized certain processes or workflows within real estate. Back then there was a very, very little traction with respect to how Proptech was infiltrating the real estate space. As we all know, real estate tends to be a little slow mover, and it just took a while for a lot of real estate and construction companies to get comfortable with this idea and find out what really was accretive about technology into one of the oldest industries in the world, which is real estate. I think that's changed dramatically in the last few years. And I think from the way that I'm looking at it, a lot of it is driven by decarbonization and looking at certain ESG targets that every developer needs to meet today, and every fund and institution, real estate institution is looking at. So when I go and talk to industry, most of the time, they're not interested in just a general Proptech solution. They're interested in something that can drive impact, whether that's social value, decarbonization, biodiversity, et cetera, et cetera. So I would say today that when we're looking at the industry, if you're not a sustainable solution today, or you don't have some form of AI, however you define that, it's going to be very very difficult to solve a pain point that a lot of these developers and institutions are trying to solve for today.
Thank you, Alex. I think that's a great way to kind of set the stage. I'd love to call on Brian next. I'm aware that you've made some investments in the space, and I'm curious as to how they're doing. What segment was the investment in? Is it in the energy segment? Is there, as Alex alludes to, an impact or decarbonization element to the investment that you made?
Yeah, so we've made several investments in the area across the I guess very different verticals in Proptech as broadly defined. But I think the way we look at it is really I'm ignoring what Alex referred to as the digitization and the Zillows, the digitization of listings and the investment platforms, crowdfunding, brokerages, et cetera, marketplaces, financing. We're really looking at the property side of things. And so from the property side of things, we look at it from two sides. One is on the construction side, and the other side is the operational side. So we've invested in both. On the operational side, we have invested in a company that does basically building automation management systems. And so it's a portfolio company called Switch Automation, which Gaw Capital has also invested in. I think we went in a couple stages before them. So we've been in it for almost 10 years now. But through technology and through management, an integrated software layer that can manage all the different sensors that you have in any building, thermostat, lighting, et cetera, you can really make a real impact on the operational costs of buildings. So in the US, the typical operating cost for building is $6 a square foot per year. And of that, about $2 per square foot is energy costs. So if you can make a dent, that's a third of the operating costs of any commercial building. And at Switch, we're targeting to save, right now 15-20%, but we think it can get as high as 25 to 50% of energy savings. So it's pretty meaningful. And you put a 8% cap rate on that's a pretty meaningful increase in gross asset value, and then with leverage, even more so to equity value. So we're excited about that. I think on a macro level, there's obviously some headwinds that we're seeing across the world, but especially in the US and here in San Francisco, where you're seeing Class A office vacancies skyrocket post-COVID. We haven't seen the return to work transition happen as quickly as we thought they would. And there's a lot of there's $21 trillion of commercial real estate office space in the US, and the latest numbers I've seen are $1.5 trillion of troubled debt coming due in the next 18 months, call it, by 2025. So how that impacts. I think the potential impact of that on the market from a macro level is twofold. Obviously, it's going to be very damaging and hurtful to asset owners. On the other hand, the pressure to improve the efficiency and operating efficiency is going to dramatically ratchet up. So we're excited about that. And then I can also talk about the construction side, but I'll leave some space for others to speak.
Picking up on Brian's reference, the first part to smart energy, I wanted to bring Jay into the conversation. Obviously, I am aware that Venturus has a smart energy portfolio company of note, and love to hear her perspective on the smart energy opportunity and how it's similar or different from what Brian talked about.
Yeah, okay. So, China actually has a dual carbon goals. So to reach carbon neutrality by 2060. And so here, so like I said, smart energy is our core focus. Within here, so we are looking primarily from the customer segment. We are looking primarily on two. One is the industrial sector, and the other one is the property sector, because the two combined actually contribute to more than 19% of the energy consumption in China. So on the property segment, so we do have a company called Anjie. So it basically to provide a comprehensive energy services and also some services related to electricity market here in China. So related to the comprehensive energy services, it's basically from the design to construction and to the operation to provide a full cycle service to that customer. So they have been done more than 1,000 projects in China, and so can save roughly 10 to 15 construction costs for the electricity and the HVAC for that customer. And on the operation side, they actually can roughly save 20% of the annual consumption. And so, in addition to that, I think you probably know Tesla Energy. So Tesla Energy has an auto bidder, so help their users to connect to the grid, so they can actually sell back their electricity back to the grid. So here, so Anjie is also doing a similar service here to help their users to optimize their electricity bill here in China. So I think it's very interesting. We also did some research on the property tax sector in the US. We actually found out US has a lot of more business models and a lot of more innovation than in China. Actually, a lot of this model actually that works in the US won't work in China. So that's very interesting to discuss more in the future. Yeah.
Thank you, Jay. I'd like to bring in, and this is somewhat deliberate, I want to get all the investment perspectives so I can set up Dominic to give his view on his current startup and how to take advantage of these different investment themes. Herbin, I'd love to bring you this conversation. I did notice, I don't know if it's how recent it is, that your growth capital fund, basically recently did a raise, or relatively recently. And obviously everyone knows it's a very, very difficult LP fundraising environment. I'm curious how you were able to do that and what was your thesis, obviously leveraging, I think Gaw Capital is a very famous real estate player, but, taking advantage of this Proptech, climate tech element, leveraging your existing business. I'm curious what got your LPs and investors excited about your new fund.
Thanks, Frank. Yeah, I think first, yes, Gaw has a great, it's great to have a platform like Gaw, where we do have the real estate, big asset platforms across the asset classes to allow us to, first and foremost, just be able to do DD, right? Because a lot of times, most of the softwares that you see in the market in the earlier days, everyone pretty much pitches the same end outcome. And so it's hard for many real estate owners to sieve out, right? What works, what doesn't work. And if you have to go through, let's just say, weeks, if at best good times it's hours, right, of calling out the bullshit, right? In terms of not just whether the software works, but whether the customer service, the follow-ups, the ability to get into the FMs, right? All these things comes from actually trial and error. To know whether it works, and fortunately for us, I guess we play in the growth equity space, where aside from whether the numbers, aside from whether these softwares works, we also look at traction and numbers, right? So in a market where interest rate is rising and everybody cares about profitability and the ability of funds to return capital, not just as a early stage venture investments, but the ability to manufacture exits and returning capital, then the ability of us to be able to then provide growth capital to companies who have emerged with numbers to support their claims has made it easier for us to look into the Asia Pacific region. And we are seeing trends, right, where from, I think, even in the Western world, some of the startups are coming to Asia and looking at companies that are similar in offerings, but then allowing a consolidation strategy. We have been looking at investments. It's just also looking at capital intensive companies as well, not just software related companies that also provides a base of, I guess, you can't call it a base of security, but ability to then invest in asset heavy or capital intensive companies, even within the Proptech space, that our LP base also wants, I guess, access to, which is increasingly a new trend in Asia as well. So yeah, I would say predominantly it's that ability to do DD as a platform first, and the ability to provide growth capital for companies that can backstop their claims with numbers.
Thank you. That's very interesting, having that very important strategic angle. So obviously we've set the stage. We have the one entrepreneur in the room. We've heard kind of the themes, where the various funds are playing. Dominic, the floor is yours. Tell us about Peace.
Hey, thanks, Frank. But I should first start off with a shout out to Gaw Capital, because Gaw Capital is one of the major investors of Naked Hub, the startup that I mentioned earlier that was acquired by WeWork. So shout out to Gaw. Well, in general, happy to talk about Peace, but also share in general what my observations from being, one of the people in the arena, so to speak. And just a shout out to all the capital. I think we still have a long way to go, because if our group here was try to draw some Venn diagrams of what the capital situation looks like versus the entrepreneurs and the things that entrepreneurs are trying to build, the Venn diagram is not so robust in certain areas. So, for example, earlier we talked about the different verticals, hardware versus software versus materials, and now versus AI. I think what I've noticed is that in Proptech, I feel it's very overweight on software and SaaS. So I feel there's a much smaller universe of so-called Proptech investors who are interested in things outside of pure software, which is quite ironic. But hopefully the trend is towards more and more capital looking at things outside of software. The second one is stage. Seed stage is also, I'd say, underweight. There's a lot of juicy growth capital funds waiting for companies to make it to the growth stage, but there's much less for the early stage. And I think third one is politics. I don't want to talk about politics too much, but it's something that all of us face here in Asia. There's a lot of different kinds of decoupling going on. And so as entrepreneurs, we need to run around within these Venn diagrams, trying to find the sweet spot for investors who match whatever particular problem that we happen to be solving. With regards to Peace, it's indirectly related to sustainability and carbon. And the reason is because what we're doing is enabling the whole hybrid work and remote work revolution. And this would be an extension of the work that was started even 8 years ago at Naked Hub and WeWork. This concept of office on demand, workspace on demand. Many investors believe that space as a service, as a theme, is literally $1 trillion opportunity. And the reason is because of what Brian mentioned earlier. There are trillions of dollars worth of real estate assets that are affected by this post-pandemic trend or acceleration of the previous trend of people being able to work from anywhere. And so that's the problem that Peace is trying to solve. The relationship between that and carbon is that the good news is that hybrid work policies are something that is within each company's control, and it can have a huge impact on the carbon footprint of the employees. It's one of the major controllable variables, and it's intuitive, I think. So if you don't commute to the office 5 days a week, your carbon footprint sort of automatically becomes a lot smaller if you work from home or if you work near home, which is a major trend in the West. And interestingly, not so much here, definitely here in mainland China, but also generally in Asia. So I think that's a fascinating trend to be following as well. So what Peace is doing is building one of the first, or perhaps the first, generative AI native marketplaces for work. Or in other words, it's kind of like a Gen AI powered booking.com for workspace on demand. So on the supply side would be flexible workspace providers like WeWork and the whole long tail of flexible workspace operators, which more and more landlords are directly doing now instead of working with a partner like a WeWork. And on the other side is anyone who needs to park themselves for 2 hours or 1 hour to do a Zoom call. So anyone who needs a little bit of workspace on demand from time to time around the city. Such a marketplace does not exist at scale. And there are reasons for that, which I won't bore everyone with. But it's a very big problem to solve, and it'll be a win-win-win for everyone. It'll be a win for the end users, of course, who can happily work from anywhere, a win for the environment because it does reduce their carbon footprint, and a win, believe it or not, a win for the landlord. And the reason is because Peace has proven that consumers will pay a very premium price for the convenience of on-demand. And so if you get enough on-demand users for the landlord, it not only covers any losses they may be suffering from remote work, but it may even increase the net operating income of the asset, which, as Brian said earlier, also that's what asset owners love to see. So that's basically what we're building here at Peace.
Thank you, Dominic. So I picked up from the initial initial comments from the panel, a number of references to AI, and obviously we wouldn't be a tech panel if we didn't have a little bit of a chat about that, and also heard a little bit about construction tech. So let's start with AI. I'll kind of do this a little bit more unstructured, kind of maybe people can just raise a hand. If people don't raise hands, I'll call on someone. But I would love to understand from the panelists in their particular verticals, portfolio companies, things that they've looked at, where they've seen the greatest impact of AI in terms of affecting the business that they've invested in.
I can happy to go first on that.
Thank you, Brian.
So on the operational side, our company Switch Automation, they've been doing this for about 10 years now, and they're installed in 5,500 buildings. So over the 10 years, they've gathered 180 billion data points. So that includes the data points on time of usage, building, room density, thermostat settings, et cetera. And all of that is really going to their ability to really use AI to optimize. So that's pretty self-evident. On the AEC side, which is the design, engineering, and construction side, we have two companies that are really doing some interesting things on both the design side as well as value engineering and construction. So automating a lot of the processes, having gathered on the construction side, we have a company that actually is doing automation for trucks and using AI and ML to have self-driving trucks. And we're working with the world's biggest contractors. And the first two verticals we're targeting are mining and construction. because those are two very repetitive closed loop environments where self-driving has an immediate impact. It's real world. It's not 5 or 10 years down the road. This is happening now, and we're replacing very, very high value, truck drivers. These are $3 million, $5 million trucks that they're driving, being operated by drivers that cost 150 to 200,000 fully loaded. Salaries, 3 shifts a day. That you're talking about $600,000 of labor costs that can be automated away, and so. Those are some pretty obvious real-world examples where we're seeing some exciting immediate impacts and applications of AI.
Thank you, Brian. Others that have already seen AI affect their portfolio companies?
Yeah, I mean, so if we look at AI and we look at construction, I talk to a lot of construction companies, Singapore, Hong Kong, et cetera. The biggest issue right now is that AI is a buzzword that a lot of people, has been around for a long time, and a lot of people don't actually understand what it means. And all the construction companies I talk to, some of them are my LPs, say, I want AI. But actually, when you look at how their processes are run today, they're still run on Excels or notepads or spreadsheets. So a lot of them don't actually have access, or they haven't collated a lot of the data that's necessary in order to actually run AI efficiently. So, the first process with a lot of construction companies is really trying to find a way to collate that data and collect that data. And you'd be surprised at some of the large companies that still operate this way. So I think AI can be an incredibly effective tool. And for example, we have a company called StructurePal, very similar to potentially what Brian was talking about, one of his portfolio companies. This company looks at it's a design tool that essentially looks upstream at design and how you can not over design a building, because when a lot of structural engineers, they tend to over design, they tend to use a lot more steel and concrete than is necessary. So there's an immediate cost impact or a cost benefit by not over designing, and also an impact benefit. You're not using as much steel and concrete, obviously. But I think on the construction side, I think it's a big issue with a lot of construction companies today is not just AI, but any technology that you're looking at. It's great to get the C-suite sort of excited about it, but getting it implemented on the ground still is taking a lot of work, and I'm seeing it firsthand. So I think there's a process and evolution to that implementation as we're seeing technology today in construction.
Thank you, Alex. Others?
By the way, Frank, I just wanted to mention that the AI company that's doing the automated self-driving trucks is called Safe AI, and they're based here in Silicon Valley, and started by a guy named Bibberjit, who actually led the AI self-driving efforts at the largest U.S. truck company, which I won't mention.
Got it. Others?
I can pick up on what Alex was saying, because if we talk about AI, then if we think about competing in AI to have the best results from AI and to build the best AI products, it ultimately all comes down to data. But the interesting part, picking up from Alex's comments, is that, a lot of real estate companies today in November 2023, dare I say the majority, are still essentially running on Excel as the tech, as the software. So that means there's a lot of opportunity in Proptech, but it means that it's still a very fundamental early stage. And part of the solution is that the Proptech industry needs to attract more talent from the design fields, the product management fields, people with consumer internet background, because you need to make decent or even great products that can win the hearts and minds of end user humans. The operators, like the truck drivers that have been mentioned, all the huge facilities management industry that has not yet been mentioned or slightly touched upon, where they're still the human operators of the buildings. So as an industry, we need to build great user experiences that engage the humans, and then the humans use the software products, and then we're able to capture the data that we need to inform the awesomeness or the awesome potential of AI-driven recommendations and predictions. Another example I can throw in on the in terms of another company that I'm aware of that I'm advising actually that is in the field of switch automation is a Shanghai startup called Aquila, and it's a digital twin type of product. Started with BIM, creating digital twins for clients with the goal of optimizing, and of course, sustainability and energy savings is a huge piece of the value proposition. So if anyone cares to Google them, you can find an article in French actually, but an article where IKEA has publicly said that it using Aquila has resulted in a 25% energy cost reduction in the HVAC piece of its building operations here in China. They have a large portfolio of retail malls along with their large stores. 25% energy saving across 5 properties with a payback of 7 months. And mainly the value is being created by getting the data on the HVAC system, optimizing software to optimize hardware controls, and then predicting those decisions in advance using AI. So another interesting example of efforts in this particular space.
I wanted to quickly get Herbin's thoughts on this. Obviously, Gaw actually has a significant real estate portfolio. I heard some comments around the still relatively older nature, offline nature, Excel nature of how properties handle, kind of their data. I'm curious as to, your reaction to that, the buildings or the properties that Gaw Capital is invested in, what percentage are digitized or at a stage where they're more forward thinking in their adoption. I'd love to hear from your perspective.
Yeah, thanks, Frank. And it's quite I think apt that there's a lot of commonalities here in the panel, right? There are companies that we've invested in or invested together with. There are companies that I've also heard and seen in the market in Asia, particularly given this big buzzword of AI, right? But I think one of the key things I would urge is the fact that it's a level of depth of understanding and the know-how of the people, right? Dominic mentioned about FMs, right? The FMs of the likes, these are probably the group of people in the real estate supply chain, also ecosystem, right? The chain where it's actually pretty hard to get them to adopt tech, let alone think about AI, because they are constantly wondering whether they will be obsolete, will they be disrupted? Or would landlords like us be catching and saying that, hey, you're not doing your job, right? You used to be running around the building. Now I know that you're not doing your job. And if you know human beings and their dynamics, right, their interactions, and if I know that this guy is not doing his job, whichever FMs, groups you are or within the buildings, why should I pay? Right now, then you contrast that to geographies in Asia, where let's just say in developed countries where cost of human labor is high. It makes sense. It makes sense for me to try to replace the ones that are not doing their job with softwares or AI, right? But then we have to think about the decision makings of the people who decides whether or not to digitize, right? Whether or not to change, and cost always comes up as a concern. But then again, I look at it again two decision trees, right? Developing countries or developed countries. Developed countries, the cost of the software versus cost of human labor, technically it shouldn't matter. It should be pari passu, almost there, if not cheaper to use softwares. But there's a human element of, the relationship there. Does it make sense to disrupt? Does it make sense to cut everything off? What if the interoperability of these devices don't work? What happens to asset management, guys, if any of the things that you're pushing for doesn't work? In terms of if one of the guys just runs out of funding, it could be running out of funding, or just because the devices all don't connect together somehow. Just think of your homes, your smart homes, right? Your Alexa, your and all these things. If your home is so smart and somehow they don't connect, they don't talk for whatever reasons. For your own home, it's okay, I guess, because you can do your own home. But imagine with somebody's job on the line for a whole building. These are real world problems there that when we think about for smart buildings or this whole transition to smart, let alone talking about AI. Right? I think AI in Asia now There are a few applicabilities, yes, but for FMs and all that, this will take time, because they are themselves worried about their own existence. And when I talk about developing countries, we also have to bear in mind when I say cost, right? Because the cost of labor, it's even more significantly lower than developed markets, which will mean the first thing in their mind is like, oh, I can get the guy to stand there and do their work, and whether or not he's being caught not doing his work, I'm willing, quote unquote, right, to hire more people to make sure that they do their work, as long as the total cost is not going to cause a lot of friction versus internally people telling me they don't know how to use certain software, they don't know how to use certain tech, right? And it takes, in Asia, at least I feel, an iron fist. It takes an iron fist at the top down to be saying that we want to transit, we want to digitize, we must do this. And that iron fist has to flow down, kind of like top down, rule of thumb, right? I mean, rule to say that I give you 6 months, I give you 3 months, you got to make it happen, because otherwise there's a lot of, let's just say, one and dance right at the top to say we will do it, and then as it flows down, it's very hard to get it executed. So I urge all founders or companies within that space, it's PropTech is actually one of the hardest industry to invest in my view, compared to fintech or any other industries, because you are looking at multiple layers of disruptions, multiple layers of B2B, B2C, where it makes sense for me to invest for the same amount of capital, right? Unless you're a sector-focused investors like us, right? I can invest in any other sectors who has better traction, better, like I said, numbers to show for, and that ultimately runs for itself, right? I always have been telling people, I said, the best type of investment I can do is to just invest and sit back and not need to worry about how to help them. But unfortunately, in PropTech, whichever range of asset class we talk about, right, from logistics to hotels to data centers to office, retail, the whole gamut, and then obviously go to construction as a subset, right, where you're looking at building materials and so on and so forth. The truth of it is always that sales cycle is very long. Because sales cycle is so long, and you now want to add a layer of AI on top, like when everybody's talking about this word of AI, right? I'm like, first, are people willing to even adopt non-AI kind of tech, let alone AI? Because that would just confuse the users. That's how I would kind of sum it up nicely. And even within Gaw, it's always a transition within a big organization like us, where you have different asset managers managing different assets in different geographies. And it really takes a top-down approach to say that we want to use certain software, certain technologies in Asia, right? Say Pan-Asia or Asia ex-China. China and the rest of the world may be different operating systems, but let's say, you want to say Japan only, Pan-Japan, right? Or developed Asia, you want to have certain matrix, certain softwares. It takes a lot to move the elephant in the house, right? I'm not to say whether it's a goal in just any other groups, right? But it is showing, because it starts from small wins in the sense that are helping the groups to see the effect or the benefits. Once the AM guys can see benefits, it flows down, it trickles down. The only resistance usually comes in the FM side because of the relationships. Because top down, you want to change it, and then you worry about, is the new tech going to survive? And if they don't, I have to go back to the OFM, and then they'll check out my price. Think about it in that dynamics. And if a group like within Gaw, and let's say I would tell my colleagues and say, hey, not to worry, I'll pay for it. I'll sponsor you. I'll subsidize you as part of my DD costs, let's say. But if it works, don't worry about it dying, because if it works, it's going to get funded. In that sense, then it's paid for, right? If it's paid for, people have less excuse to not move. Because in big groups, people care a lot about where's the budget going to come from, so on and so forth. So in that sense, my job is a lot of my times, aside from looking at investments and whether the thesis makes sense, whether yada yada as a group equity, it comes to a lot of education and I would say education, trying to encourage my colleagues in various asset class and regions to think about adopting these different technologies, small little wins, to allow them to be more embracive to do as a portfolio. But that is of why I said investing in PropTech is hard because of that all these nuances.
This is just an observation for me. I've always been in tech and tech investing, and just listening to the comments from the group. Just a simple observation. It seems more of a B2B opportunity versus B2C. And just listening to everyone, it seems very fragmented. So how do you think about, kind of investing to maximize return? Is it more, because typically with B2B, you need some scale, right? You need customer penetration, versus B2C, which has a little bit less friction, right? I'm curious as to how you guys look at it. Just listening to this, it seems very fragmented. I'm not aware of any kind of prop tech company, and with the exception of, I guess, everyone's heard of WeWork, et cetera, and maybe you want to put Airbnb in that category, kind of big B2C, platforms. I'm curious. That's kind of my listening to this panel. I walk away that this is very fragmented.
Maybe I should take this in the Asian context, or at least how I see it. It's true. I think a lot of people in the region, when we talk about prop tech, generally is the prop or the tech, right? Prop comes first or tech comes first? That's always the $1 million question for the word and how you define what is prop tech, and that's why it's such a broad word, right? But essentially, if you look at B2C, I actually think more money is being made in B2C, just because for venture capital, for the capital growth, looking at matrix, right? Because sales cycle is very long in B2B. These are essential investments, I believe, to digitize and then enable smart building and the next generation of buildings, right? Or green buildings, so on and so forth. But will typically then, if you just benchmark that as an investment against all the other potential ways you could deploy your capital, they may not make the best returns. Just on average, right? But when we look at B2C, marketplaces and so forth, where typical venture funds who are, let's just say, generalist, right? You're able to then track it or benchmark it, and there has been a lot of at least in how I'm seeing it, even the intersection between fintech and real estate. That has always been also a theme that allows then more investment, more capital. And that's why there's always a 1.0 wave of PropTech, right? Where people are in the early days investing to these B2C companies, because that's how you see VCs able to see small wins along the way to be able to take a longer term view to say we'll do also the B2B. And not to mention B2B or SaaS companies, if you're in China, for example, I mean, not forgetting the politics and macro markets today of exits, right? Just B2B companies being valued in China versus, Western world. There's also a gap in those valuations, even in the old days, right? So when I look at that, even within B2C, then we look at marketplaces, I look at the search agents side of the business, right? Brokerage, and that's usually the as Brian was alluding to earlier, it's not looking at that side of the business, right? You're looking at more of the constructions and all that, because that's adding that end value to the buildings. But in my early days of investing in PropTech, right, it's a lot of these much more quote unquote scalable sectors or companies, TAMs, that we would usually see returns or exits.
As an entrepreneur, I voted with my feet to go after the B2C opportunity for the reasons that Herbin already mentioned. However, there is a playbook that really can be used in PropTech to bridge the two. So when we come to the topics that we discussed earlier of how to engage, for example, the FM people, which is millions of people operating buildings, or it's also been mentioned about the sales force that sells real estate, and also the consumers who might rent an apartment. We can create software products that are excellent at the consumer level and engage end users as individual people first. And then if the product is good enough, those people will invite their colleagues and their team and their bosses, and eventually it's growing. The software usage is growing within the real estate organization. So hopefully this is starting to sound familiar. This is the playbook of companies like Zoom, the playbook of companies like Dropbox. They're actually product-led SaaS companies that ultimately wind up as huge enterprise SaaS unicorns. But the path to get there wasn't by hiring a very expensive $150,000 a year huge team of salespeople who are good at selling complicated SaaS products with 1,000 features. No, you build a great product, a simple, great product, and it really engages individuals because it solves a real pain point. It might be a small win, as Herbin mentioned, but you just win them over, and it works for them, and they start inviting the other people that they need to transact with in their daily work. So I think this is an interesting opportunity for Proptech startups to use this as actually a more capital efficient way to scale. By the way, that's the strategy that Peace is adopting as well.
Yeah, I would just add to that. I think, Frank, you nailed it. The market, at least in the US, is extremely fragmented, but it's huge, right? In the US, residential and commercial real estate accounts for 22% of the GDP. So this is massive. It's a huge part of the economy, and there are millions, tens of millions of people employed and involved in the entire real estate industry. So, and this is as old-fashioned a business as it gets, right? These businesses have been around for hundreds of years. There are relationships that are decades old, and we talk about the FMs. These are extremely entrenched players with very strong incentives not to change. And so while technology can solve a lot of the pain and problems that we see and the inefficiencies we see in the market, you really need to overcome all these vested incumbents who really don't want change. And so for us, when we invest, the number one thing we look for is speed to market. And if we think something looks great from a technology standpoint, but we don't see how it's going to get to market, it looks great on a piece of paper and it may look good in the lab, but we try to invest for reaching commercial traction and successes as early as we can. And so when we invested, for example, in the self-driving trucks, right? That this is a $2 trillion construction is a $2 trillion industry in the U.S. And the number one cost is labor. And so for them, the owners who make the decisions every single day, that is something that they want to address, especially in a highly inflationary market with labor tightness. Being able to address that. Every single customer we've gone to has said, yes, we need this yesterday. And decision making is a lot quicker and smoother when you're dealing directly there. And so for us, like I said, it's time to market and friction to market is the number one thing we have to get confidence that can be overcome for us to want to back companies.
Yeah, I think that's really important. The idea of friction to market. Unlike Gaw, we don't have sort of one defined property company go to. Our LPs are a mixture of data center developers, construction companies, etc. And what we try and do is we try and research some of the pain points there, because if we can define a pain point, then we can already define a market. We can define a way in, right? And I think one of the upsides to real estate is actually one of its downsides, is that it hates change. So if you do manage to get a technology into a construction company or a real estate developer or a big institution, chances are if that technology doesn't screw up, they're going to keep it. So the ARR, the continuing revenue of this business, will continue infinitum. We've just got a business that we invested in 5 years ago that's still going with the same customers and posting a really healthy return. And I think also, you're not having to spend a lot of money on customer acquisition, right? There's a sales cycle for sure, but if you go through venture capital firms like Herbin's firm and my firm, I think, again, supporting those businesses, getting them into do pilots and commercial contracts, that doesn't cost a whole lot. That's relationship. And I think that, again, Brian was talking about that idea of relationships. This is a very relationship-driven business. I've seen a lot of technologies, again, that are amazing. They've built one of the best bio products for insulation, for example, with zero carbon. And but the guys producing it have no idea, or inventing it have no idea how to get to market. And so they produce something which may not have a, or might in theory have a home, but there's no pathway. So I think in this business, venture capital firms and accelerators actually are more important than in any other business within venture capital that I've seen, because you need to be able to assist these companies to get into market, to get through that pathway, to break down those barriers. And like Herbin was saying, you know, to really help them, encourage them to move forward. So I think whilst it may not, you might not see the listings and the massive, 500 times returns you might see in consumer tech, I think it's going to be a bit more steady eddy, right? And I think the industry and the market size is gigantic. And I think if you layer on sustainability and some of the regulations that are coming down in China, in the rest of the world around this particular issue when it relates to built environment, I think you're going to see a lot of impetus and a lot of momentum for change within the built environment, infrastructure, construction, and real estate.
Years that impact and the whole environmental consciousness has risen significantly. I'm curious from the panelists, has that changed anything in your thesis? Is it simply a macro demand that there's greater pull through, or do you look at investments differently as a result of this significant shift in prioritization from the property owners?
Why not just jump in real quick, because it is our thesis. It makes up everything we do. Okay. And we look at impact and how it's going to impact from 5 different themes within our investment charter. So that's decarbonization, circularity, resource efficiency, social value, climate adaptation, nature positive. And I think that we chose these themes because we did a massive amount of research in the built environment to understand where the regulation was heading, where were some of the motivations heading. And unfortunately, I think in the real estate space, regulation plays a really important role. I'm not saying you should invest in something just because regulation is changing, but I definitely think that this is the motivation to get real estate owners and construction companies to move. And when you look at what's happening in Europe today, and I think this will change the way Asia looks at this space as well. By 2027, most European brands will have to operate the same way they operate in Europe and meet the same requirements. So what that means is if you're a real estate owner, you're going to have to retrofit your building to basically provide a place for these brands to go that fits within their own requirements. And I think that commercial incentive on behalf of those tenants, or that impetus on behalf of the tenants, is changing the way that a lot of real estate owners in Singapore, Thailand, Hong Kong are also looking at these places, because they do not want to lose these luxury brands out of Europe, for example. So for us, we see a massive tailwind here. And I can tell you 24 months ago, I walked into a developer that will remain nameless in Hong Kong, and I pitched my strategy, and he said, listen, climate change is not an Asian problem, it's a Western problem. It doesn't happen in Asia. 24 months later, that individual is in my data room. And that just shows you the speed at which this has moved. And I think, like everything in Asia, once things move, they move very, very quickly. And I think China's no exception, right? And I think Southeast Asia, North Asia, they're really changing the way they're looking at this space. So for us, it's fundamental to everything we do.
Interesting. Others?
Yeah, just a little bit of touch. It's Alex just mentioned in China. So actually, China just published its first ESG, its own ESG criteria last year, and this too. So it's not enforced yet, but I think I agree with Alex. China is moving along the similar path as in the US, Europe, and in the US. However, at the present, so we are still more focused on the scalability of the business, also the customer value, whether it can help customers on the CapEx side or OpEx side. So I guess I think it's very dynamic environment, and not sure if the regulation in Asia, specifically in China, can keep the pace with Europe. But I definitely very look forward to it, because I think with that happening, it actually will create a huge market for companies here. Yeah.
Yeah, I'll just add on, and maybe one of my comments is actually just that this whole regulation support subsidies or the carrot and the stick, right? That's just good in terms of how I'm looking at for decarbonization. But that's just one piece of the equation for Proptech, right? If you're still looking at other sides of the technologies that is not related to decarbonization, however you want to put the link to it, right? Say tenant engagement, wellness, so and so forth, brokerage, you're not going to link brokerage to decarbonization, right? But for all these other pieces of the business it used to be what I call the good to have. Good to have, I used to say, is good to enhance the usability of your buildings or your assets and so forth. These regulations wouldn't help. As in, these decarbonization regulations wouldn't help, but it's still good for me, because that just means that it makes my job easier when I look at these companies or whether your hardwares or softwares, because the impetus to move by the industry increases. So everyone has the impetus to move, then now they are willing to then look at companies and just be choosing now from A to D, right? The whole gamut of solutions, and see whether they want to do it. In the past, you're still even wetting your toes to decide whether do you want to start choosing. So in that sense, these are small wins that I think having that regulation helps, particularly so in certain sectors like EV mobility, EV charging, so and so forth, rooftop solars, which are all the decarbonization side of the business.
I would just add to that. I think it's important for governments and public sectors to have a role, and an important role in the adoption of these impact mandates on the private sector. On the other hand, we look at it. We do make a distinction between what we think are effective mandates versus mandates that are really more just window dressing. And I think we all know what we're talking about. There's a lot of greenwashing out there, and there's not really bona fide good faith effort for true adoption of standards. But on the other hand, for example, in New York City, the governor there has implemented Local Law 97, and they're requiring all buildings to have ratings, and they all have to be carbon neutral by 2030. So that has teeth, and so investing in mandates that are going to be forced from that perspective makes a lot of sense to us. But you have to be careful differentiating between what's real and what's not.
Okay. If I could wrap up now, kind of my final question, and juxtapose with the backdrop of the recent APEC meeting, Sino-US relations. It's interesting. We have a very global set of investors on here with China experience on this panel. Do you look at this Proptech sector? Are you investing in a local company, a regional company, a global company? Kind of what is your thought? Can this product or service, go global, or is it still similar to kind of the internet sector where it was kind of China, the rest of the world? Or because of the property element to this, is it a little bit more regional in nature? So I'm curious as to how people approach this, as an entrepreneur, as an investor. Are you trying to build a global company, a regional leader? What are you trying to build?
I actually think that, it really depends on the technology, right? And I think Jie talked about this, it's not one size fits all for sure. However, having said that, when I speak to large institutions or large developers that have, massive geographical presence, they don't want to be dealing with multiple technologies within their business. So I think there is a massive opportunity for these technologies to scale. I mean, politics aside, that's something else I won't necessarily get into. But just on the structural side, if you're scaling with a Blackstone, for example, over multiple jurisdictions, that's super interesting, right? Assuming that technology has the capacity to do that. I mean, with Undivided, we look at technologies coming out of Europe, some out of the US, other places in Asia, but it all has to scale into Asia. So at DD phase and our process phase, we have to make that assertion. So yeah, again, not one size fits all, but I think there is a massive opportunity to scale.
Others?
As an entrepreneur, I think I would think about early stage prop tech products and early stage prop tech startups from the lens of product market fit. What you're trying to do is design a product to fit a big enough market's needs. But when that comes to real estate, I think, as we've already discussed in this panel, the other panelists have mentioned, it's a very, very local business. And so from that perspective, it suggests that it would have to at least start local and focus, achieve product market fit, get that initial commercial traction, and then have the good problem of globalization and then localization for other big regions aside from the original region. It's really hard to generalize because it will really be case by case on the specific type of prop tech product that we happen to be talking about.
I think I couldn't agree more there. I think like if politics is a local business, I think real estate is even more so a local business wherever you go. But fortunately, I think real estate is such a big portion of every economy that every local market is big enough where you can prove yourself. And if the concept works, then you go to these cross-border transnational owners like Blackstone or even Gaw, where they have the ability to cross-border and apply technologies from a top-down standpoint. But there's so much friction just trying to get into each local market that even a top-down approach, I think, is not as easy to implement as it may sound.
Final thoughts?
No, I just kind of agree more with all the other panelists. Just go, but to me, it's go local. Just
Got it.
Go local, then you can start thinking global.
So I'll give Jay the final word.
I guess just do it country by country. Yeah, that's it. Yeah.
Understood.
So we've talked a lot about some of the challenges that I think the real estate market globally is facing in China, in the U.S. with the empty commercial office spaces. And I look back at all the different economic cycles that we've seen over the last 30 years since I've been investing. And I think anytime, especially when you have these macro headwinds of higher for longer, supposedly, in interest rates, and this economic chaos that we might be facing soon with the property markets, that is always, without fail, in every cycle, been an opportunity for disruption, both technologically and from an investment standpoint. So it's actually counterintuitive where there's chaos. I think as investors, we see that as opportunity. So I'm excited about where the next. I'm a lot more excited about the next 3 years investing, I would say, than the last 3 years. That's for sure.
Well, thank you, Brian. So on that note, I've really enjoyed this conversation. Hope you did as well. Thank you to all the panelists on behalf of Venturis Group. Really appreciate all of the insights on PropTech. And thank you so much for agreeing to join this. I learned a lot myself. Thank you so much.
Yeah.
Thank you.
Thank you.
Thank you, everyone.